friends. In financial market series, this is my 10th video. In this video, I am going to explain about offer for sale. First 9 videos links are available in the description box. There are several ways for the investor to invest in primary market. IPO, initial public offer. FPO, follow-on public offer. Bonus issue, right issue. Offer for sale is also one method of investing in primary market. Through offer for sale, investor can invest in listed company securities at discount. Let us see the meaning of offer for sale, OFS. Offer for sale is a mechanism which facilitates the promoters or promoter group entities or shareholders to sell a part of their shares on stock exchange platform. With the meaning, it is clear that through OFS, promoter group entities and shareholders of company, they can sell a part of their shares to public. So here promoters, promoter group entities and shareholders, we can call them as sellers. As company is not issuing new shares here, company's capital doesn't increase in balance sheet. And sale proceeds also do not come to company, they go to promoters. Now the question is, why promoters are selling their holdings to public? Are they really not interested in the company? Not necessarily. So the reasons may be any one of these 4. First one, to comply with the minimum public shareholding norm. Complying means following. Norm means rule. As per SEBI regulations, a promoter of a listed company should not hold more than 75% stake in company. Suppose a promoter is holding 80% stake. He can dilute his stake in company by selling 5% shares to public under this method. Second reason is personal reasons. Investing in one company is just like investing in an asset. Assets are created to help them in difficult situations. So here also, promoters created their assets by establishing one company. So when they need money for their personal reasons, then they can sell these shares to others and they can get that money. Third one, for diversification. So with the help of OFS, promoters can make some changes in their investment portfolio. So they can sell some shares of existing company to public. With that amount, they can invest in other business. Last reason is abandoning a sinking ship. So this is a red flag to the investors. If company's position is not good, if company is going to be liquidated in near future, that information comes to promoter first. Because through internal sources, easily he can get that information. So if this is the reason for this OFS, then investor should not purchase this company shares under OFS method. So before investing in OFS, investor has to dig deeper into the reasons behind this OFS. If company has a future growth potential, if the reason is not abandoning, in that case, investor can purchase shares through OFS method. Next one, which company can issue shares under OFS? Don't think that the sellers of all public limited companies can sell their shares through OFS method. The promoters of top 200 listed companies can only sell their shares under this method. On what basis these top 200 companies are considered? Based on market capitalization. So the promoters of top 200 companies with highest market capitalization can only sell their shares through this method. Next one, evolution. So SEBI introduced OFS method in February 2012. So public sector undertakings and public limited companies used this method extensively. Later, government started using this method for disinvestment in public sector undertakings. So through this method, government started decreasing its stake in public sector undertakings. So today, this method is extensively used in public sector undertakings. Previously, through this method, only company promoters, promoter group entities are allowed to sell their shares. But today, even shareholders holding more than 10% stake in the company can also use this method to decrease their stake in the company. Next, offer size. So if any company wants to go for OFS, then minimum OFS size should be 25 crore and company should offer minimum 25% stake to institutional investors, nothing but to mutual funds, insurance companies, and minimum 10% of OFS company should reserve for retail investors. Retail investors means common investors, general public. Next, who can buy shares under OFS? Let us see the list of investors who can invest in shares through this method.
Retail investors means individuals. Mutual funds, foreign institutional investors, FIIs, insurance companies, qualified institutional bidders, QIBs, HUFs, Hindu undivided families, non-resident Indians.
Next topic, procedure. Let us see the procedure of selling shares under OFS method. First step, approval of BOD, Board of Directors. So the sellers who want to sell their securities under this method should approach BOD. They should put their proposal in front of Board of Directors. So if company's memorandum of association and articles of association permits, then Board of Directors approve this proposal. Then company should go to stock exchange, and before 2 days of OFS issue, company should inform to stock exchange about its intention. Why company should inform to stock exchange? Because only listed company shares can be traded through this method. Similarly, through stock exchange, company is going to sell these shares to public. So, information to stock exchange is must. Next, offer for sale document. Company or issuing house prepares offer for sale document. This document contains complete information about the company and about this present offer. By seeing this offer for sale document only, investors will come to know about this company. Here, company is issuing this document, but not for company's sake. Money goes to promoters, no? So in favor of promoters, company is issuing this document to public. Therefore, we can treat it as deemed prospectus. Let us see the contents of this document.
Offer document contains the following information. Name of the seller and company means promoters, promoter group entities, non-promoter shareholders names and the company's name. Second one, name of the exchange. So name of the exchange where the order shall be placed. Suppose orders are placed through BSE and NSE. In that case, one exchange should be declared as a designated stock exchange and its name should be mentioned here. Then date and time of the opening and closing of the offer. Next, floor price. What is floor price? I will explain later. Next, cutoff price. About cutoff price also I will explain later. Then allocation methodology. So to allocate the shares to shareholders, there are two methods. Single clearing price method, multiple clearing price method. Under which method stock exchange is going to allot the shares to public. That method name also we should mention in offer document. Next, number of shares being offered for sale. Then conditions. Conditions if any for withdrawal or cancellation of the offer.
Fourth one, a separate window. So through stock exchange shares are sold under this method, no? So in stock exchange website, a separate window will be opened for OFS. So stock exchange places this offer for sale document in that website. So investors have to frequently verify stock exchange website to know whether there is any new OFS of any company. Then how many shares one can buy? Sometimes sellers may include lot size in this OFS issue. Suppose lot size is 50. What is the meaning of that? Public have to apply for minimum one lot, and one lot contains 50 shares. Means one investor has to apply for minimum 50 shares. He cannot apply for 10 shares or 20 shares. If lot size clause is not included in this offer, then investor can apply for even one share also. Sixth point is fixing the issue price. issue price is also known as cutoff price. This is the price at which shares are sold under offer for sale method. To fix the issue price, there are two methods: fixed price method, bidding method. Under fixed price method, seller only fixes the issue price. Investor has to purchase the shares at this price. Second one, bidding method. Under this method, seller invites bids from the investors. So based on the bids received, based on the demand for that issue price will be fixed. Later, I will explain about this method clearly. Next, requirements. If investor wants to apply for shares under this method, under OFS method, what are the requirements? He should open one demat account and trading account with a registered broker of NSE or BSE. He should have a bank account and permanent account number, PAN card. Next, how to apply? There are two methods to apply for shares under OFS method. First one, through online. Second one, through offline. In online method, investor has to log in into his trading account. So there he can see IPO oblique OFS option. He has to select OFS option. There he can see different companies OFS. He has to select the company in which he is going to invest. He has to give quantity and bid price. While giving this, he has to keep in mind that there are two categories to place his bids. First one, non-institutional investor category. Second one, retail category. So he should select appropriate category and he should apply for shares. If he cannot apply through online, so then by taking the help of his broker, he can place the bid offline. Next, bidding categories. So there are two categories under which one investor can place his bids. First category is non-institutional investor category, also known as general category or non-retail category. If the bid value which is placed by investor is above 2 lakh rupees, then investor should place his bids under this category. Next, suppose bid value is 2 lakh or below 2 lakh, then investor has to place his bids under retail category. Not only this, who should place bids under which category? Let us see this topic in detail.
Client category, OFS category. Hindu undivided family, HUF, has to apply under non-institutional investor category. Individual has to apply under retail investor category, or he can apply for non-institutional investor category also. So if the investment value is below 2 lakh, he can apply under retail investor category. So if the bid value is more than 2 lakh, then he has to apply under non-institutional investor category. NRI can apply under non-institutional investor category. Corporates have to apply under non-institutional investor category. Partnership business can apply under retail investor category or non-institutional investor category.
Under OFS method, transactions will be settled in T plus 1 day. Here T stands for transaction day. Next day of transaction day is called T plus 1 day. So on transaction date, stock exchange issues shares under OFS method. So if you belong to first category, general category, on T day only you have to apply for shares. You have to place your bids. If you belong to retail category, on T plus 1 day you have to place your bids. Next, about floor price. Floor price is the minimum price at which investor has to place his bids. So below that price, sellers are not ready to sell their securities to public. In IPO or FPO also, bids are invited from the investors. There we can see two prices, cap price and floor price, maximum price and minimum price. But in case of offer for sale, you have only floor price. There is no cap price. Means minimum at which price investor can place his bids, that is available, but maximum limit is not there here. Generally, floor price will be less than market price. Market price means the price at which shares are traded in stock exchanges. Suppose floor price is 100 rupees. If market price of that share is also 100 rupees, then nobody prefers to purchase that share under OFS method. Because in stock exchange, share is available at same price. Then why investor should go for OFS? So this is the advantage to investors. Under OFS method, investors can purchase listed company shares at a discount price. The price which is less than market price. One day before the issue date, company informs to stock exchange about this floor price. So stock exchange announces that price in the portal one day before the issue. Why only one day? Why not well in advance before the issue? Suppose company informed to stock exchange about the floor price 10 days before OFS issue. During these 10 days, investors will come to know that OFS is going to come. They know very well that they can get the shares at a discount price under OFS. They stop trading the shares in stock exchange. So slowly, as demand decreases, market price decreases. And one more point is, there is no rule that compulsory company should inform about the floor price one day before the issue. Generally, companies inform to investors about the floor price. If not, company can maintain secrecy. In that case, company can put this information in sealed envelope cover and it can submit to stock exchange. Here, investor doesn't know about the floor price, no? In that case, investor can bid at any price because there is no floor price condition here. Next one, margin. OFS is backed by 100% margin money. Means, suppose there is one investor who is going to apply for 2 lakh worth of shares under this method. Then in his trading account, 2 lakh rupee money should be there. And when he applies for shares, immediately stock exchange blocks this 2 lakh rupees. If shares are allotted to him, then okay. Otherwise, that blocked amount will be refunded. Next, modification or cancellation of order. Investor placed one bid. Can't he modify that? Can't he cancel that order? Yes. OFS is open only for one day, no? So if during that day, at any time, investor can modify or he can cancel his bid. If investor's bid is backed by 100% margin, then during that day, at any time, he can modify or he can cancel his bid. Only the condition is last 30 minutes of issue closing time, he cannot make any changes. Till that time, he can modify or he can cancel. Suppose investor's bid is not backed by any margin. In that case, only upward modification is allowed. Means, suppose one investor applied for 1000 shares at the rate of 100 rupees. Bid price is 100 rupees, bid quantity is 1000 shares. So only upward modification is allowed. He can change the number to above 1000. So 1200, 1300, 2000, but he cannot change to below 1000. So he cannot make this quantity 800, 500. Same thing is applicable to bid price also. So he can increase this number 110, 120, but he cannot decrease it. Next, let us see the allotment procedure. So when company receives bids from the investors, how company is going to allot the securities to them? There are two methods under which stock exchange can allot the shares to them. First one, single clearing price. Second one, multiple clearing price. So according to the instructions given by the sellers, stock exchange is going to apply any one method for the allotment of securities to investors. Let us see the first one in detail, single clearing price. Single clearing price. With one example, I will explain about this type of allotment. A company wants to issue 10,000 shares under OFS method. And a company is ready to give 5% discount on cut-off price. So how cut-off price will be decided under this method? Let us see. Columns are bidder, bid quantity, bid price, allotment price, allotted quantity, cumulative demand. There are total 19 bidders. So company received bids from 19 different bidders. Bidder 1 applied for 606 shares. he wants to purchase 606 shares and one share he is ready to buy at 330 rupees. So his bid price is 330 rupees. Bidder 2 is ready to purchase 625 shares. So bid quantity is 625 and he is ready to pay 320 rupees on one share. So bid price is 320 rupees and so on. Observe the cumulative demand 12,980. How this number came? 606 plus second bidder quantity 625 is equal to 1231. 1231 plus third bidder's quantity 645 is equal to 1875 and so on. So supply is for 10,000 shares, available shares are 10,000 and demand is for 12,980 shares. This is known as oversubscription. So company cannot satisfy all shareholders because available shares are less than demanded shares. Here company first decides cut-off price, issue price. On what basis it is decided? Let us observe. Suppose 330 is fixed as issue price. Then company can sell only 606 shares because only first bidder is ready to pay 330 rupees on each share. So 330 is not the cut-off price. Come to second bidder. He is ready to pay 320 rupees. If 320 rupees fixed as cut-off price, then company can sell how many shares? 606 plus 625, 1231 shares. But company has to sell 10,000 shares, no? So 320 is also not the correct price. In that manner, if you observe one by one, come to 14th bidder. So here cumulative demand is 10,217 means 14th bidder bid price is 200. So at 200 rupees company can sell its full shares to public. So 200 is fixed as cut-off price. In this example, 200 is the issue price, cut-off price. At this price, company allots shares to these bidders. And bidder 14, 15, 16 and 17. So these are 4 members quoted same bid price, 200 rupees. So up to 17th bidder, company has to allot the shares. 18th bidder and 19th bidder. So their bid prices are below the cut-off price. Therefore, company is not going to allot any shares to them. Company wants to give 5% discount now. As cut-off price is 200 rupees. On this 200 rupees, this 5% discount will be allowed. So 5% on 200 is 10 rupees. So 200 rupees minus 10 rupee is equal to 190 rupees. So each bidder has to pay 190 rupees on one share and company is going to allot shares for first 17 bidders now. So here cumulative demand is for 10,817 shares. But available shares are only 10,000. So 817 shares extra. This is oversubscription. So company allots the shares to them on pro rata basis. And the calculation is, come to first bidder. So 10,817. If this is the demand from bidders, then company can allot only 10,000 shares to them. So for every 10,817 shares, if company is going to allot 10,000 shares, bidder 1 applied for 606 shares now. So for 606 shares, how many shares company has to allot to him? This is the question. 10,000 divided by 10,817. If you calculate this, 560.2. So in points, shares cannot be there now. As after point digit is below 5, we will ignore this. So 560 shares. So to first bidder, company issues 560 shares. Come to second bidder, same question. So if public apply for 10,817 shares, company is going to allot 10,000 shares. If second bidder applied for 625 shares, then how many shares company is going to allot to him? 10,000 divided by 10,817 into 625 is equal to 577.7. After point digit is more than 5. Therefore, one number we can add here. So 577 becomes 578. So to second bidder, company is going to allot 578 shares. In this manner, company allot the shares to bidders. Second one, multiple clearing price. This is most popular method. Under this method, company allots the shares to bidders under price priority method. Means the bidder with the highest bid price will be given priority while allotting the shares. First bidder applied for 606 shares now, and his bid price is 330 rupees. Even though cutoff price is 200 rupees, company allots the shares to him at 330 rupees only. And 5% discount company is going to give now. On 330 rupees, we should not calculate 5% discount. We have to calculate discount on cutoff price only. Cutoff price is 200 rupees now. So 200 rupees into 5 by 100 is equal to 10 rupees. And allotment price is 330 rupees minus that discount 10 rupees is equal to 320 rupees. And the company allots 606 shares to him. Full shares are allotted to him. Come to second bidder. Bid quantity is 625 and the bid price is 320 rupees. Company allots total shares to him. 625 shares are allotted to bidder 2. And allotment price is 320 rupees minus discount 10 rupees is equal to 310 rupees. So bidder 1 has to pay 320 rupees into 606 shares. Bidder 2 has to pay 310 rupees into 625 shares. In that manner, company allots the shares. 14th bidder, his bid price is cutoff price only. So at this price, how many shares will be allotted to him, that we should observe. Up to bidder 13, company allotted 9,817 shares. So available shares 10,000. In that, to first 13 bidders, company has allotted 9,817 shares. So the remaining shares are 183. These 183 shares are allotted to bidder 14, 15, 16 and 17. Because these 4 members bid price is cutoff price 200 rupees. So if you add their required quantity, 400 plus 300 plus 200 plus 100 is equal 1000 shares. Let us find out the ratio for this. So bidder 14 is applying for 400 shares. 400 shares is to bidder 15 is applying for 300 shares. 300 is to bidder 16 200, bidder 17 100. So remove common zeros. 4 is to 3 is to 2 is to 1. So the remaining shares 183 will be allotted to these 4 members in this ratio. So bidder 14 gets how many shares? 183 shares into his number is 4 now. 4 divided by, add these 4 numbers. 4 plus 3 plus 2 plus 1 is equal to 10. So 73.2 shares. Nothing but 73 shares. So to bidder 14, company allots 73 shares. For bidders 15 also same calculation. Remaining shares 183 into his number is 3 no. So 3 by 10 is equal to 54.9 shares. Nothing but 55 shares. So to bidder 15, company issues 55 shares. In the same manner, if you calculate for 16 and 17, then their allotted shares are 37 and 80. Come to bidder 18 and 19. Their bid prices are less than cutoff price. Therefore, they won't get any allotment. So under this method, if bid price is more, there are more chances for getting the allotment. But investor has to be very careful here. Suppose this company's share outside market price is say 200 rupees and he has quoted 330 rupees per each share. If company allots shares to him, 200 worth share he is buying by paying 320 rupees. So it is loss to investor. On the other hand, if bidder quotes less price, then the problem is that price, if it is below the cutoff price, he will not get any allotment. So carefully he has to observe at which price he has to bid. Next, let us see when transactions will be settled under OFS method. In case of non-institutional investors and institutional investors with a 100% margin, transaction will be settled on T plus 1 day. Here T means transaction day. On that day, shares will be issued. T plus 1 day. On that day means on second day, transactions will be settled. Means if shares are allotted to bidders, then shares will be deposited in their demat account. Shares will be credited to their demat accounts and money will get transferred to promoters. On Monday, if shares are issued under OFS method, by Tuesday, transactions will be settled. Next, institutional investors without any margin. For them, transactions are settled as per the existing rules of stock exchange. Next, come to other important points related with OFS. Real-time basis with a system-based bidding platform means transactions are settled under this system transparently. So promoters cannot cheat the investors. Time to time, stock exchange reveals the cumulative bidding quantity and prices. So promoter cannot cheat the investors by fixing higher cutoff prices. Next one, normal trading will continue. Normal trading means the trading of company securities through stock exchange at market prices. So when offer for sale is going on, some investors can trade this security through stock exchange also at market prices. Next, refund procedure. Suppose one bidder got partial allotment. Otherwise, he didn't get any allotment. In these two cases, he should get the refund now. So when he applies for shares, when he places his bid from his trading account, money will get blocked. In case of partial allotment or non-allotment, that money will be refunded to him. When? On the same day, on T plus 1 day after 6 p.m. Next, charges. In normal trading procedure, how much charges we have to incur? Same charges will be incurred under OFS issue also. So there are no extra charges here. And who should bear these charges? As sale proceeds are taken by the sellers, promoters group entities and shareholders. Charges also they have to bear. So this is all about offer for sale method. Hope this video is helpful to you. Thank you.